Today we have Jeff Sott, Raymond James Chief Investment Strategist. You know him. He's the guy who knows all the details of what's going on. By the way, he called that downturn over the summer exactly so, and he has another downturn expected. We're going to be going to him for the details. Ken Croft also joins us, Leo Minster president. He's going to tell us why he thinks the Fed is still the #1 market driver. And Larry Shover joining us from the pits of the CME. Larry, I got your notes at about 9 o'clock this morning. First of all, let's just talk about the overall mood of trading. It does seem like there's a little pause in trading right now, no?
Yeah, no, you're exactly right. Very quiet, very thin. And for the Fox family, the takeaway is that what this does, it encourages traders to grab a hold of any shred of information to help justify their trading positions. And you know, with the dearth of information out there, the lack of headlines that are credible, headline risk starts to punch far above its weight. And so with that in mind, we're seeing a lot of air pockets, a lot of grinding away, but no real conviction in the marketplace.
So, Jeff Sott, it seems, according to Larry anyway, that we're kind of teetering at the top right now. Do you agree?
Yeah, there have been some divergencies that have showed up over the past couple of weeks. The timing model that called the downturn last July and August is suggesting the same thing here for the next couple of weeks.
Okay, let me just emphasize, Jeff, for those who don't know, you timed last summer's pullback of about 6%, almost to the percentage point, correct?
That pretty close.
And you see another one coming. Tell us about it.
Well, the market's straight up here since October 9th, I believe, was the near-term reaction low. We've been straight up. A lot of the indices are overbought on a short-term basis. A lot of the macro sectors are overbought on a short-term basis. I do think the natural forces of the market suggest some kind of pullback here, which should set up the fabled Santa Claus rally into year-end.
Boy, that would be nice. Now, I'm going to stick with you, Jeff, for a moment. Ken has some specific stocks. I'm going to go to him for a second. But Carl Icahn, I know what you're saying, Jeff, and yours is absent any personal investments. But do you think Carl Icahn is talking his book in some way when he suggested yesterday that there's going to be a pullback similar to the one you suggest?
Well, he's a lot smarter than me, and he's a lot richer than me. It's very difficult to call the short-term moves in the market, but I do think you've got a shot. It's just like flying an airplane in blacked-out conditions. You have to pay attention to your indicators or controls in an airplane's case. And right now, it's suggesting that you should be a little cautious. Longer term, I think we're in a new secular bull market that has a lot higher to run.
Okay, but let's continue with the short term, at least for the next couple of months. Kent, you think that the equities are still undervalued? How so?
Well, I do. I think, especially given the status of U.S. balance sheets of U.S. companies, the cash on hand, the low debt levels, and what debt they do have is low-cost debt. Balance sheets are the best I can ever remember, and valuations are not unreasonable for a lower type interest rate environment. So I think near term things might hinge on interest rate policy, but I think that creates might create a really good buying opportunity for the long term.
I think if there's a pullback before the end of the year, I think Jeff's right. We may have a Christmas rally here, but Jeff, there is still a lot of cash on the sidelines. That gets to Ken's point. Why is there so much cash?
Because people think you need to have this feel-good environment to have a new secular bull market. And in reality, by the time you get that feel-good environment, it's usually pretty late in the game. Like, it was real easy to buy tech and telecommunication stocks in 1999. It wasn't a very good strategy, but it was real easy to do. The markets do not care about the absolutes of good or bad. All they care about is, are things getting better or are things getting worse? And I think things are getting better.
All right. Well, Kent, one thing I think everybody agrees is getting better, at least in the United States, is our energy situation. We have an energy creation that the likes of which I've never seen in my lifetime, particularly with natural gas. You have some natural gas picks. If you believe in natural gas, why are these the ones?
Right, and we really do. We think this is transformative type stuff for possibly decades. It gives us in the U.S. especially an advantage. So I think any long-term portfolio deserves some attention here. And a couple names: Williams, they operate pipelines, so generally benefit from increased usage. Quanta Corporation, or Quanta Services, I should say, they build out the pipelines. to move the gas around. And Southwestern Energy owns some of this stuff. So I think you can play it different ways, but it's good to have exposure in a long-term oriented portfolio.
Kent, we saw some healthcare picks on there as well, Express Scripts and Mylan, a generic drug firm. Explain why you like these companies.
Well, healthcare, anytime there are times of uncertainty like there is obviously in healthcare right now, we look at it as, looking through these names for opportunities, especially ones that will perform well over that longer term period. And these are companies that really are enablers of helping decrease healthcare costs. Generic drugs obviously are cheaper than branded. Express Scripts manages pharmacy benefits, and that is helps drive costs down over time as well. And we think they're very reasonably valued at 12, 13 times earnings.
All right. And finally, Jeff, you called the August pullback almost to the percentage point. How big of a pullback do you think we need to see over the next couple of weeks before we begin to see any bargains back in the stock market?
Well, I think there's always bargains in the stock market. If the S&P breaks below 1760, I think you could get a 5 to 7% pullback, but I think it's for buying, David.
Jeff Sott, good to see you, my friend. Kent Croft, great to see you. And Larry Shover, always a pleasure. Thank you, gentlemen.